Welcome back to my channel. I got some interesting, delicious things for us to talk about today. This video is going to be a little bit different. This video is going to, well, for the past couple of videos, I did a video about uh, how become monetized to YouTube, how I became monetized. Soon I'm going to be dropping once I become monetized for a full month, and when I finally do get paid, show you how much uh, my first paycheck or whatnot. As right now, I'm looking, it's quite small, but I'm not being going to be discouraged. I think I'm at like 25 cents right now, 25 cents a day or whatnot. So, but still not gonna let that discourage me. When still stay the course. But as for today's video, before we start, just know. Past performance does not guarantee any future performance. None of this is financial advice. It's for educational purposes only, and we're just here to learn and just have fun. Today's video, I'm going to talk about three things that I wish I knew before I started investing. I'm going to talk about this article, but then also I'm going to talk about my particular portfolio and my mistakes that I've made, and I've made several. So hopefully you guys will understand that here I'm being vulnerable and I'm being sincere and everything. So, for you to understand a little bit about me, I was born in Chicago, Southside Chicago. I was raised in Milwaukee, Wisconsin, and always been, I would say poor, lower middle class. I went to school, went to private school. I worked my way up, still working, still grinding. So I've never been a person of privilege, never been a person to, uh, with a silver spoon in my mouth. So everything that I have or that I'm working on, I work hard, especially as a black man. I work hard uh, for everything. I work three, four times as hard to get to where I'm at right now, and even to set the foundation so that if one day I do want to have children or a family, that I can build a business, build a trust for them, and have something to lead towards them. So take that everything that I'm saying. It is small walk. It's my experience, but it's a valuable experience. And so as we dive in the article, this I like to look at the Motley Fool, uh, and in the Motley Fool, uh, the first tip that says is don't worry about trying to time the market. And with this is important because this goes back to my tip because I'm going to go through a Motley Fool and then go through my tip to include. So it says number one is don't worry about trying to time the market. I translate to for me in my lesson is start early. And right now in 2023, this is the best time to start investing. To start, whether it's in crypto, whether it's your 401k, open up a Roth IRA and letting it be open for at least 5 years and not wait. Right now is the best time where when I was investing, my first brokerage was Scotch Trade, and to buy per stock it was like $6.95. Even right now, since everything is such a competition, you can buy stocks on Charles Schwab and Fidelity for nothing, pennies on a dollar, which is good. So back then, it was you had the cost of no 65. I mean, $6.95 per transaction, which sucked, really did. And then also back then, which was like I would say about at least how things changed, like 7 8 years ago, uh, when I was like 24, 25, because when I graduated from school, it was around when I was like 24, and I got my first job, and I wasn't making a lot of money to invest. It took uh, you couldn't buy partial shares. Like now you can buy partial shares, and so now it's way easier for you guys to be able to invest and start early. But right then to buy ETF or buy index fund like for Vanguard, you have to have the whole $3,000, 3,500 to buy it. Right now you don't, and so uh, don't worry about time in the market. Start early. Start as early as possible to let that compound start. In other videos, I've gone through examples of compound interest calculator. Have talked about how when you start small with 100, 150, $200 a month, how you break it, how to create a budget. I'm not gonna go through all that today, but those are the small things of breaking a big goal, a big task down into its molecules and into just something small where you have a goal of $200, do $100 per check, then you can increase to 150, then you can do $200 per check, and it really helps to start out early. The earlier you start, the easier it helps to develop those habits to want to invest, but also it helps to develop a large pot. And so I'm going to talk about like my portfolio. And so right here, uh, I have a goal for myself. The goal to I want to say 100,000. So my goal is to hit 100,000, six figures, and then my second goal is then to once I hit 100,000 for all my portfolios, then for my taxable dividend portfolio to invest enough to get this to 100,000, and then to get from that from 100,000, get it to 200,000, so on, so that by 50, I want to be able to leave the country, sell my house, leave the country, and just I don't know, be in Panama, be in Australia, I don't know, probably be in Italy or you never know, probably Eastern Europe, you never know. But that's my goal. It's nice to have goals, write it down, stay consistent. But this is when I started at 25, but I didn't get serious with investing until when I hit at least 30. Now I'm about to be 35, and so when I say that I've been investing for 5 years, I've been investing for more than that. But I would say that I used about 2 or 3 years where I was trying to figure things out. I was trying to beat the market, and I was trying to index funds and trying to beat the market, and I had ego, and I learned a lot from just not trying to do too much. So uh, right then and there, if I were to, you know, so I told you I've been investing for 5 years, but I've really been investing for like 8 years. If since I started out younger, I would have loved to start out at age 20 when I had little side jobs, and then uh, put $100 here, $100 there, $100 there, and then when I was able to do more, do more, because then I would have definitely would have had more than what I have right now. And by the age of 30, I can really see that with the help of me putting in and starting out younger, and with the help of the market, because before then, we have been in a bull market for like 8 years, and so the market would have helped me a lot along the way, especially with those times when the market was given like 30, 38, 40% annual returns. So imagine if I by 25 had saved at least 10,000 and let that 10,000 just run, and then also invest into by the age of 30, I would have had a nice little pool, and then as I grew into my career to make more money, I would have had more of a chance. So my first goal for first is right here. It says don't worry about time in the market, and I also would add on to it is that start young or start as early as possible. Even with your children, promote to uh, start early. To number two, tip number two is timing isn't critical to long term success, but time is, and that goes hand in hand with my last point, started early. But also, what I'm going to include as well is to invest regularly. Timing isn't critical to long term success, but time is, and investing regularly. And what I mean by that is that what you learn is that the money that's being taken out of your account bi-weekly to buy whatever you buy in your 401k that you're not really paying attention to. After a while, 5 years, 10 years, if you go back, you'll see that you've your pot have grown a lot because you haven't tampered with it. You haven't, when the market was down, you sold. You just continuously did your thing. You bought groceries for your family, took your family on trips, pay bills, live life, and then you come back 5 6 years and you see like, wow, I have 20,000, 25, $50,000. How's that possible? It's because when it's when it's red days, when the days of the market when it's down, when the market is down 1 2%, it's ugly. And everybody feel like, oh, I just want to sell. Guess what? You still working your job, getting a paycheck, and then some of your gross is buying those shares on a down day, and then when we're in a bull run, as the curve goes up, you are buying as the market goes up, and then you also buying as the market goes down. And if you know what the average is, if you begin to average it, you begin to average along the way. You dollar cost average. So basically, your job with the 401k, it kind of forces you to do like an automatic uh, dollar cost average. So if you wanted to do your own dollar cost average, take the money that you get paid, and you choose a day or a day per month or 2 days per month, and you do it regardless of the market will go up and down, dollar cost average. And so timing is a lot of times a lot of people do is that they want to wait until the market is like really really down where you can dump the money in, which is cool, but the market is unpredictable. You never know. Like, give you an example. 2 weeks ago, we had that whole bank failure. It was fear in the market. You had the Fed Chair Jerome Powell. You had that one lady from the Treasury where she said her piece, and then for 2 days it was red. Right, it was red. Market was down, and I was ready. I was ready about to put money into the market and buy stocks while I was down. Then what happened is that Friday or Monday, the market went up, and so like the market was really only affected like maybe 1 or 2 days, and then the market shrugged it off and was like, oh well, and then the market just went right back up, and then the money that I was going to dedicate to why the prices were down, I couldn't really do it. So the whole time in the market, I mean, it's good in theory, but it's hard to time it. So that's why a lot of people just dollar cost average, and then it's really about the time that you stay in the market because you can't predict the market. So just buy, have high conviction in stocks that you believe in. If you believe in Apple, if you believe in Microsoft, J&J or United Healthcare, Apple, Coca Cola, Pepsi, Amgen, Enbridge, whatever stock, Home Depot, Lowe's. If you have high conviction, if you are in real estate and you believe in O Realty, if you believe in Home Depot or Lowe's, then whatever your stock in your stock portfolios, just buy it regularly. Buy every month or every 2 weeks, and then just ride it out, and you'll see whether it be with a dividend growth calculator, portfolio calculator, or other people's videos, or even just you see with my stocks, or it's possible. If you buy per month, every 2 weeks or every month, it adds up in the long run. The combination of your portfolio growing, your portfolio paying out a dividend, the dividend increasing, the dividend reinvest back into the stock, buying more shares, and then you put money into your portfolio as well, increases your dividend portfolio. I would have I see for me, I wouldn't have dreamed to have a $41,000 portfolio. Me coming from the hood, me growing up in the ghetto or whatnot, me growing up in humble beginnings in Wisconsin. But and this not even a large portfolio. It's just this is a small portfolio. I've seen people who have portfolios that of 100,000, 56,000, 250,000, and it helps to motivate me to stay consistent. Instead of time in the market, time in the market. So when the market goes down and everything is all else fails, do I just sell and be like, you know what? Oh my God, I can't trust the market. I'm just gonna sell everything. I'm gonna take my 41,000 and I'm just gonna just live in a jungle. No, no, because these are stocks that I have high conviction in. Let me show you. These are stocks that I have high conviction in, and instead of trying to time the market, I'm just gonna buy every 2 weeks. I'm gonna buy every month, pick and choose a day, and I'm gonna buy Mo. I'm gonna buy Allstate. I'm going to buy Starbucks and Broadcom and UPS and Best Buy, stocks that people are familiar with, brands that if if you took the words but you just put pictures and whatnot, you'll know what it is. You know what Union Pacific is. You know what railroads are. So Home Depot. So with two, invest regularly, don't time the market. Dollar cost average, time in the market beats time in the market. And for the last tip, it is 1% makes a huge difference. Uh and with this, it's because always when you are investing, just keep in mind that uh, when you are investing, keep in mind that whether it's an ETF or index fund, keep in mind the expense ratio that they are charging you. If it's over, if it's 1% or more, it's too much. A 1% difference in a annual increase goes a long way, and just keep in mind of what these ETFs or the index funds, what these funds or these fund managers are charging you, because on a per year basis, it can really eat it up. And as you see right here, uh, it gives you an example with Jim, Jane, and the difference that if a person was invested, uh, for 20 years, the difference of what 1% uh, annual return would be, an extra 1% annual return would be. For example, for Jim, with all uh, variables the same, where they both Jim and Jane are investing 3,000 per year. If Jim was to get a 6% average return, and Jane was to get a 7% annual return, but they both can contribute the same thing, within 20 years, Jim will have $116,000, but Jane will have 130. And then, as you see, as you go an additional 200. I'm not 200. That's crazy. Probably be dead. An additional 20 years, 40 years of investment. Jim will have a portfolio of 492,000, not too shabby. But Jane will have 640. Then, if a person will have 60 years, that's crazy. But you know, it will go to 1 million and 2 million. So the difference of 1% is crazy. Now imagine the difference between an additional 3-4%. Imagine you invest in, and that's why people invest into growth stocks and single stocks, because then you're able to get more annual return, more bang for your buck. But uh, highly risky. It's risky. It's more bang for your buck. But hey, so all in all, I wanted to go over uh, just tips that I've learned, tips that as a beginner investor for you to look out for. Remember, start early. Try to start early. If you haven't start early, the first best thing to start investing was yesterday. The next best time is tomorrow. So if you are 30, 35, 40, hey, it would have been nice for you to start at 20. It would have been nice for me to start at 20 or 25. But guess what? We all have to deal with the cards. If you play spades, whatnot, or card games, you gotta play the hand that you're dealt with. And so, uh, rule number one is to start early. But if you can't start early, then do your best with what you have, which means start now. Start at 30. Start at 35. Buy, you know, different growth stocks, different ETFs to get you to your goal. And then most importantly, watch my other videos to show you how to leverage buying growth stocks, buying dividend stocks, buying, incorporating the different portfolio, different strategies on developing. I have videos on how to invest in your 30s, how to invest in your 40s, 20s, different stocks. And so this is my channel. It's for everybody. It's all inclusive, for you guys to learn just how to survive. And this information is not only for new investors, but at the same time for also uh, premium, consistent investors and investor community that is probably investing that stocks you probably haven't heard of. And I constantly look at videos, and I get knowledge of information of stocks that I haven't heard of, or different strategies. And uh, this is how we get our information out, and you learn. Because If you don't stretch yourself and you don't challenge yourself, you don't grow. So hopefully you guys uh, learned a lot from uh, my video and learn from my mistakes. And if you have any questions, feel free to write it down below in the chat. Comment. Tell me what you like, what you didn't like, and most importantly, let's motivate each other and let's invest for the future because we all know that Social Security is not going to be around. So hope you guys enjoyed my video. All right, guys.